Welcome back to Financial Market Insights for Traders. I'm Sophia. Today's episode is one of those moments where markets, politics, and history collide. The fall of Nicolás Maduro is no longer something analysts speculate about in footnotes or long-term scenario planning. It has happened. And whether you trade oil, commodities, currencies, or global macro themes, this is an event that will shape markets for years. When Maduro was removed from power in early January 2026, the immediate reaction across financial media was shock. But markets didn't panic. And that tells us something important right away. This wasn't an emotional move. It was a recalibration. For more than a decade, Venezuela had been effectively frozen out of the global financial system. Not because it lacked resources, but because its political leadership made those resources unusable. The country holds the largest proven oil reserves in the world, yet it became one of the weakest producers. That contradiction sat in the background of oil markets for years, like a locked door everyone knew existed but assumed would never open. Now that door is open. The first thing many people expected was an immediate spike in oil prices. After all, regime changes in oil-producing countries often trigger supply fears. But instead, crude prices barely moved, and in some sessions they even drifted lower. That wasn't market complacency. That was realism. Venezuela's oil industry has been hollowed out. Years of underinvestment, sanctions, corruption, and loss of skilled labor have left infrastructure in poor condition. Wells need maintenance. Pipelines need repairs. Refineries are barely functional. No serious trader believes that Venezuelan oil will flood the market overnight. Markets understand timelines, but what has changed is the future. Oil markets don't just trade barrels, they trade expectations. And the expectation that Venezuela might remain a political and economic black hole forever has just been removed. That alone changes how long-term supply is priced. Even small increases in Venezuelan production, spread over years, could matter. Oil is a margin-driven market. A few 100,000 barrels a day can shift pricing power, especially when demand growth is slowing and alternative energy sources are gradually expanding. This also reintroduces Venezuela into OPEC politics. For years, Venezuela was a member in name only. Its influence vanished as production collapsed. A recovering Venezuela would want relevance again. That would complicate quota negotiations and potentially weaken the grip that other producers have on supply management. There's also the issue of crude quality. Venezuelan oil is heavy, and heavy crude is not easily replaced. Certain refineries, especially in the United States, are designed specifically to process it. If Venezuelan heavy crude returns, it changes refinery margins, shipping routes, and pricing relationships across regions. Then there's sanctions. Under Maduro, Venezuela became one of the most heavily sanctioned energy producers on the planet. Those sanctions didn't just limit exports. They kept capital, technology, and expertise out. With Maduro gone, the possibility of sanction relief becomes real. Not guaranteed, but real. If sanctions are eased gradually, Western energy companies could return. And that matters more than people realize. Venezuela doesn't just need money. It needs technical expertise. It needs project management. It needs operational discipline. Those things don't come from ideology. They come from experience. Export flows would also change. For years, Venezuelan oil went largely to China at discounted prices. If Venezuela re-enters global markets, those flows could shift toward the United States and Europe. That would reshape global crude trade routes and force adjustments across the energy complex. China, meanwhile, would need to reassess its exposure. Venezuela was not just an oil supplier, but also a borrower. Debt repayment structures tied to oil shipments may need to be renegotiated. That adds another layer of uncertainty to global commodity trade. Oil is only part of the story. Venezuela also holds significant natural gas reserves that have barely been developed. Political normalization could unlock investment in gas production and power generation. Over time, gas could play a larger role in domestic energy supply and regional exports. Refining is another overlooked area. Venezuela once had a robust refining network that supplied fuel across Latin America. Under Maduro, that network deteriorated. Fuel shortages became common, even in an oil-rich country. Rebuilding refining capacity would stabilize regional fuel markets and reduce volatility in gasoline and diesel prices. And beyond energy, Venezuela's commodity footprint is substantial. The country holds large reserves of gold, iron ore, bauxite, and other minerals. For years, much of this activity existed in informal or illicit channels due to lack of governance. A stable government could bring these resources back into regulated global supply chains. That matters for industrial metals, inflation expectations, and long-term resource planning. Interestingly, in the immediate aftermath of Maduro's fall, gold prices moved higher. That reflects uncertainty, not optimism. Investors sought safety as geopolitics shifted. At the same time, Venezuelan bonds surged from deeply distressed levels. That tells us markets are already looking ahead, not just reacting to chaos. This is what re-rating looks like. For years, Venezuela was uninvestable. Not risky, uninvestable. That distinction matters. Now, markets are beginning to treat Venezuela as a high-risk, high-potential opportunity instead. That shift alone changes capital flows. Energy stocks with potential exposure rallied. Emerging market investors began reassessing Latin American risk. Currency markets took note. This doesn't mean stability is guaranteed. Political transitions are messy. Power vacuums create uncertainty. Institutional rebuilding takes time. But markets don't wait for certainty. They move when probabilities change. And the probability of Venezuela reintegrating into global markets has increased significantly. There are also broader geopolitical consequences. Russia loses a strategic ally in the Western Hemisphere. China faces uncertainty over supply and debt. Iran's regional network weakens. Meanwhile, the United States strengthens its influence over energy dynamics in the Americas. Energy is not just about supply and demand. It's about power. Who controls resources, who finances production, and who sets the rules. The fall of Maduro reshuffles that board. For traders, this environment demands attention and adaptability. Oil, commodities, energy equities, and emerging market assets will continue to react to developments coming out of Venezuela. Policy signals, investment announcements, and infrastructure projects will all move markets. This is not a one-week story. It's a multi-year one. That's why having the right tools matters. Trading volatile, macro-driven markets requires speed, clarity, and risk control. Platforms designed for modern traders can make a real difference in how effectively you navigate uncertainty. If you're actively trading global markets, it's worth using a professional-grade platform like Crystal Ball Markets that's intuitive and built for real-world conditions. And just as important as tools is education. Understanding why markets move is what separates reactive trading from strategic decision-making. Geopolitical events don't exist in isolation. They interact with inflation, interest rates, growth expectations, and investor psychology. Staying informed helps you see connections before they show up on the chart. That's why ongoing market education, whether through podcasts, research, or analysis, is such a powerful edge. One such podcast is the Crystal Ball Markets podcast, which you can find on rss.com/podcasts/Crystal Ball Markets. The fall of Nicolás Maduro is not the end of a story. It's the beginning of a new one. One that will redefine energy markets, commodity supply chains, and geopolitical alignments for years to come. For traders and investors, this is a moment to stay engaged, stay curious, and stay disciplined. Thanks for listening to Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next episode.